afternoon, and welcome to another episode of Moving Markets, the Safe Option Strategies podcast. I am Jeffrey Dunyan. Glad to have you here. It is Friday, the 26th of January, 2024. It's just been maybe 20 minutes or so since the U.S. markets closed. Yesterday, if you tuned into our podcast yesterday, I teased out a little bit that I'm going to talk a lot about inflation today. I've got some information to cover, and I know for some of you that listen to this, it's going to seem quite elementary. You have a good understanding of what's happening with inflation, what causes it, what could fix it, what is not going to fix it, even if it might temporarily put a Band-Aid on it. But I'm going to bring it down a little bit to a level that everybody can understand, and I want you to really kind of wrap your mind around why some of the recent inflation numbers, while better than they were, no question about that, may not be as positive as you think, and there may still be some reason for concern. I'm not going to be all doom and gloom. We're improving, and that's the important thing, and we've improved a lot. But I still want to explain why inflation is still a problem, why so many Americans are feeling like it's still a problem, and are not feeling things easing up the way the media would want us to feel about it, or the way the current administration would want us to feel about it. I'm going to take a minute and talk a little bit about the GDP numbers that came out yesterday. I talked briefly about that when they came out yesterday. I'm going to talk a little bit more about it today, and we're going to talk about those PCE reports that came out this morning and what those numbers mean going forward. So enjoy the rest of the presentation, and let's get right into it. So let's start out talking a little bit about what happened today and maybe why it happened. The Dow Jones Industrial Average up 60 points on the day. That's a new record close for the Dow. NASDAQ down a little bit, only 0.33%, 55 points down on the NASDAQ. Not a real bad, horrible day. 0.33% is not a real big deal. S&P almost flat, down 3.19 points. That is less than 0.1%. And the S&P, I don't remember, I was watching Liz Clayman's show on Fox Business News as we were going into the close of the market, and I can't remember how many times she mentioned that the S&P had gone into positive and then negative territory. If we pull it up over here on CNBC, it did hit a new 52-week high today, but the intraday movement, this gives you an idea of the number of times it was below and then above and then back below and then maybe got above and then stayed back and forth and finished just a little bit to the downside. But really, for all intents and purposes, it was a flat day in the market, and that's the only way to describe it, especially from the S&P standpoint. If you were watching futures this morning, when the stock market opened, the PCE numbers were revealed or reported officially. And the numbers, just like the GDP numbers yesterday, the PCE numbers came in just a little bit, I would say either in line or just a little bit better than what was expected. And let me show you what I mean. The personal income came in exactly where the estimates were, but that is down a little bit from where it was the month before. Personal consumption was a surprise to the upside. That means how much we're spending as consumers. That number was better than expected, but that's not necessarily a good long-term sign for inflation. When you look at the month over month, came in exactly in line. Year over year, very, very close. This was off just a tiny bit, a little bit better than what was expected. And then the core PCE year over year, and a lot of people tout this as the main inflation number that the Fed looks at. This is what Jerome Powell has been saying for a while. He wants to see this get down to 2%. And it is steadily moving in that direction, and that is a good thing. And then, of course, it came in just a fraction better than what people were expecting. Now, that number, all these numbers being a little bit better than what was expected, sparks the debate about what does this do with the Fed and the Fed's possible decision on whether or not they're going to raise rates or lower rates or keep rates the same. And that's been the subject of debate. We've been dealing with this. Every Fed decision for several years now, the question has been, do they raise rates again? Do they leave rates the same? Do they bring them down a little bit? Right now, the strong consensus, 97.4%, is the probability that the current rate of 525 to 550 is going to remain the same. Okay, that's what that means, that 525 to 550 right there. A few small percentage of people are thinking that maybe next week when they meet, they lower rates, but that's not a lot of people. Go out to the next Fed meeting in the latter part of March, and now things start to change a little bit. You've got a pretty much 50-50 split on those that think it's going to stay the same and those that think it's going to be cut a little bit. So you put these two groups in the cut category and these two groups in the stay the same category. Just a short time ago, this was more up to the tune of 60, 70, 80% of people that thought that, or I'm sorry, this combined group right here. Sorry, I was saying the wrong one. There was more of a consensus that by March we would start cutting rates. Now it's more balanced. Get into May, and then you start to see the heavier percentage of people, add these together right here, and this comes up to 89%. 89% think that rates are going to get cut in May. The debate gets sparked with these PCE numbers because better than expected numbers might, for some people, in their mind, increase the probability of the Fed cutting rates because they say, oh, look, everything is great. Inflation is coming down. Everything is beautiful. It's wonderful. It's time to cut rates. But the only reason for the Fed to really cut rates is if we're falling into a recession, and there's not right now with those good GDP numbers, there's not really a sign of that happening. So let me use all of that as kind of the segue to talk a little bit more about the GDP numbers and the inflation specifically, because there's a little bit to unpack and a little bit to digest as it relates to these numbers and how, what to look for in the coming weeks and the coming months and how it could affect the market. So let's go back for a moment to the economic calendar and let's go back to yesterday's GDP report. So the expectation for GDP was 2% growth in the quarter, and we came in at 3.3. And this was what had the markets on fire yesterday, was that phenomenal, amazing GDP number. 3.3 is not amazing, but it's dramatically higher than what was expected. But here is the problem, and I don't want to sound doom and gloom. I don't want to be a naysayer. I don't want to just look for the negative. I honestly think of myself as a more glasses half full person than glasses half empty person, but I'm going to sound the opposite about it. And if you look at the great numbers that we had last quarter, there are a couple of things that are concerning to me. This is where I'm going to sound glass half empty. Last quarter, of that 4.9%, the two largest areas of growth in the economy were healthcare industry, which is largely fueled and funded by the government, Medicare, Medicaid, VA benefits. Now, there's also some private industry healthcare stuff going on in there, but the largest portion of the healthcare segment is fueled by government spending for Medicare, Medicaid, and VA benefits programs. The second largest last quarter was other government spending, not counting healthcare, which means an expansion of government programs. It means an expansion of government employees. It means our tax dollars being spent to fuel the economy. In this quarter's report, the largest area of growth was government spending. It was second largest last month or last quarter. It was the largest one this quarter. 3.3 is a great number. I'm not going to throw a wet blanket on that and say that that's not a good number, but it is not a sustainable thing for tax and spend to carry the economy. That is what drives inflation. Too much money chasing after too few goods is the reason we have inflation. And when the government continues to tax us and put money into the economy in that way, The economy itself, the organic growth of the economy, businesses, personal income, not government spending, is not growing enough to keep up and create a better situation. Productivity is not going up. Uh, Supply chains are not being fulfilled. If you want to, when you've got a situation with inflation where too much money is chasing too few goods, the answer is not for the government to continue pumping more money in the hopes that spending stays high and the demand or the supply eventually catches up. The answer is increase the supply, and supply gets increased when the private sector is expanding more than the government is expanding. The government does not produce anything for us. They do not make a product of any kind. They do not build anything. They simply take our tax dollars and redistribute it into the economy, and that is not growing the supply. The supply comes from when corporations are making more products that can then keep up with the demand and balance out that inflation situation. So even though these are great numbers and they're keeping us away from that boogeyman term inflation, or excuse me, recession, they're keeping us away from recession. There's kind of that negative effect, and that is where this growth is coming from, and why it should be a little bit of a concern to everybody. Now, let's shift gears for a minute to inflation and talk about what all this has to do with inflation. I kind of mentioned it and kind of touched on it for a moment, but here's the situation that you need to be a little bit concerned about as it relates to the inflation picture. I get really, really frustrated. And I would even go so far as to say I get kind of ticked off every time I hear someone in the mainstream media, every time I hear someone from the government talk about inflation going down, as though the decline in the rate of inflation is somehow equal to prices coming down. It's not. And it's, I mean, I really truly believe I could go and explain this to a class of third graders, and they would have a better understanding than a lot of the public as it relates to inflation. You keep hearing the administration talk about our messaging is not good enough. We're not getting credit for the good things that have happened. We don't know why people are still feeling bad about the economy when things are getting so much better. Now, look, again, I'm not going to throw a wet blanket over and say that the declining numbers here are not an improvement. But here's the false sense of security in the way this is being presented and the way this picture is being played out. June of 2022, year and a half ago, is when we hit 9.1% inflation, and that was over, I believe, a 40 to 45 year high on inflation rates. And that was bad and that was ugly. And there was not much of a way to spin that. Each month thereafter, with the exception of a little bit of an uptick at the end of last year, and I apologize, this goes to September 23rd. This has come down a little bit again, and now we're at that 3%. Okay, that's and I know this is CPI, and we were talking about PCE, but they're pretty close in terms of numbers. So this was at 2.9. So we came up a little bit for a couple months, came back down a little bit, and now we're hovering around this 2.93 mark. What people are so quick to forget is that this is 3% more of prices going higher, not somehow magically 6% decrease in prices. The way the media pitches, and I know they don't come right out and say it this way, but the way they pitch it is as though we were at 9% inflation back in June, and now we've come down 6%. We've come down 6% in the rate of increase, but we haven't gone backwards 6%. That would require this bar being 6% down below the zero mark, and we're not even close to that. If we go back to September of 2022, which let's see, June, that would have been May, April, March, February, January, December, November, October, September. That would have been this mark right here. This, I believe, was around 6.5 or 7.5. So what you've got is 6.5 or 7 right here, plus another 3.7 right here. That's what the real story is. So what you have is, over a 2-year period of time, more than 10% of price increases and no price decreases. This is not a decrease in prices. It is simply a slowing down of price increases. Here's a really simple way to look at it. This is why I feel like I could go to a class of 3rd graders and they would understand this. Imagine this zero mark. Imagine this zero mark is your home, and this is where your wallet is at, okay? You left for a trip out of town back here, and you left your wallet home. And every single bar on this graph is you getting farther away from home and accelerating. Right here, you're going 14 miles an hour away from home. Right in here, you're going 70 miles an hour away from home. At its peak, you're going 90 miles an hour away from home. You are getting farther and farther and farther and farther away from where you want to be, which is back here, so you can grab your wallet and have your money and be able to have a good vacation. All this represents right here, all this represents is the car it is still moving farther away from home. It's just not going as fast. Instead of going 91 miles an hour away from home, now in September of last year, we're only going 37 miles an hour away from home. Fast forward to the numbers that just came out this morning, and instead of going 91 miles an hour away from home, we're going 29 miles an hour away from home. And last month it was 30 miles an hour, and this month it's 29 miles an hour. Every single one of these is getting farther away from where we want to be, and that's not good news. Is it better that we're going 29 miles an hour away from home than going 91? Yes, it absolutely unequivocally is. And that shows that the rate increases are having the proper effect. But the reason the average person out there, is not feeling great about the economy is because each one of these bars right here represents another month of prices going up. And wages are not keeping up with that, and people are depleting their savings accounts. The other thing that should be a little bit of a concern in those PCE numbers is that, we had 7%, almost double the amount of consumer spending as what we thought we were going to get for the month of December. And that's not a good thing when you consider that more and more of it is going on credit cards, and more of it is coming out of people's savings, which are becoming depleted. Our rate of savings is at the lowest point it's been since the start of the pandemic. So was the PCE number good? Yes, it was good. It came in better than expected. And we want to see this continue down until, at the very least, it gets down here to 2. And then if wages are going up higher than that and inflation is 2% or lower, someone from home can bring us our wallet and have a chance of catching up with us. Okay, we're probably not getting back to zero, and we're probably not going to deflation where prices are going to come down. But if our wages increase, the increase of wages is like a friend or a neighbor, we called them on the cell phone, they grabbed our wallet, and they're trying to catch up to us now. And they have a better chance of catching up to us when we're going 29 miles an hour than they do when we're going 91 miles an hour. So that's why we don't necessarily have to get to where we're having bars that are moving down below this zero mark, but we at least have to get down, at the very minimum, we have to get down to where it's that 2% or under, and whoever's trying to catch us from home can actually catch up, that being wages. So that's kind of where we find ourselves in this picture. And again, we're moving in the right direction. There's no question about that. I like that we're moving in the right direction. That's me trying to go back to the glasses half full instead of glasses half empty. But you've got to be careful. And like I said, it ticks me off when people in the media are painting this out to be something different than it is. Is it an improvement? Yes, I've said that a bunch of times. I'll stop saying it. It is absolutely an improvement. Is it where we need to be? No. Are we getting ahead? No. We're giving ourselves a better chance of catching up, but we're not there yet. And we've got to be careful that we don't start assuming we are. GDP numbers were good. PCE numbers were good. There's some things that are going on that are not good, and we've got to be careful. And I think, we may see that chink in the armor as it relates to the market in the upcoming months. The rally, I think, is going to fizzle a little bit as more companies report next week. The big tech companies are reporting. Meta, Microsoft, Google, Apple, Amazon. Those are part of the Magnificent Seven. They're all reporting next week. They're not only going to have to report really good numbers, they are all going to have some really strong guidance, some really strong outlook for this market, this most recent leg of the rally to not roll over and fade away. So that's what we're going to have to watch for in the coming weeks and in the coming month. All right, I know I got up on a soapbox about this one today, but I wanted to give you my take on GDP, PCE, and inflation. I'm going to wrap up right there for the day. Everybody have a fantastic weekend. We'll see you back here on our podcast on Monday. That wraps up and concludes today's podcast. I hope you got some good information from that. I hope it was enjoyable. I hope you'll come back every day that the markets are open and check out our podcast. You can see it on our YouTube channel. You can check it out at sostrades.com if you want more information on our memberships and our subscription plans. Never forget, I'm gonna talk about this every time I do one of these podcasts. Never forget that the members of our program get the benefit of the trades that we send out. We've already closed out a couple of nice profitable trades this calendar year. Last year, 114% return on the trades that we sent out to people. So make sure you go to sostrades.com. Make sure you check that out. Subscribe to our YouTube channel. You can, on the website that I just gave you, you can subscribe to get updates when we have them on other information. We put some articles up there once in a while that are free for anybody that wants to go there. And then if you're watching this on some other platform, make sure you like it or comment on it and give us some feedback. Let us know maybe some topics that you would like us to cover or some things that you would be more interested in. Again, I hope you enjoyed today's presentation. Join us next week, Monday after the market closes. Thank you.